Let's go through our options basics right here, and then let's move on to the trading platform, and then I'll show you exactly how these things work. In this video, we will cover the long call, which gives the buyer the right but not the obligation to buy the underlying asset at a specified price within a period. The long put gives the buyer the right but not the obligation to sell the underlying asset at a specific price within a specific time period. The short call is the exact opposite of the long call. By selling the option, you obligate yourself to sell the underlying asset at a specific price. Yeah. And the short put is the exact opposite of the long put. By selling a put, you obligate yourself to buying the underlying asset at a specific price. Now go into the platform and then see how we do things here. So here I've selected SPY. I'll go through it and then I'll show you exactly how I select it as well. So I've opened up, selected SPY. Now remember, this is before trading hours. It's not 6:30 a.m. yet in Pacific. So you see NAs here. You don't see any net change values, nothing, because the markets are not open yet. The futures market is still open. If you look at all the futures, this is the watch list. I'll show you how to create your own watch list, what to watch and what not. And to begin the course, we have gone into SPY and I've selected a 31-day cycle. 31 days to expiration. That number comes up here, and then the expiration is 17th of November this year. And on the right hand side here is the volatility of this expiration cycle, 17%, and this plus minus is the expected move. The SPY ticker is expected to move 19.256 points from now till the expiration. That's what all this is about. This is my first time of this course. There will be so many changes, so many different suggestions coming in. I'm happy to make any changes that you any changes that you think are going to be beneficial for our community. Just let me know. Just keep posting it, and I'll keep making all the changes because I want to improve myself too. Now, one very important thing I look at is the open interest and the volume column. I will do a separate video on volume and open interest, but these numbers have to be more than a couple hundred in the open interest column. Volume, you see NAs because nothing is traded yet. Volume is the daily trading volume, buy or sell. Open interest is basically how many contracts are actually open right now. That's what this is. And the point of this course is to go through some long calls, some short calls. So here I'm going to take, this is the put side on the right hand side, and this is the call side. So the money is here at 50 deltas. So my closest one is 53. I'll select that one, and I'll hit the ask on this side. When I hit the ask, that means I am buying a call. Now my platform is set up for 5 contracts by default. I don't ever trade 5. I don't know why I have set it up as 5, but I don't ever trade 5. I only ever trade 1 because in order to keep and manage our risk, we start with 1 and then we scale in. But here's the long call. This is what the payoff diagram looks like. These are the probabilities. These numbers that you see here. Let me just put my pen out so I can show you what I mean. So here, this number is the probability of this option moving in the money or out of the money, right? Now, here, this is where the strike is right now. This is where the underlying asset is trading right now. This is your break-even point. Now, when I say break-even, you should calculate, you should see that if your strike price is 433 or 434, you need to add in $10.39 in order to get to break even, right? And that's where you will break even. And then your option needs to go all the way. Long story short, this is how the call option looks like. This is your defined risk because you traded 1 contract. It's the cost of 1 contract. The teal line is basically a max loss, and then this purple line is, well, your profit and loss right now, your current P&L. So here, when we start from here, the current P&L is 0, obviously. We will be negative because we will be paying this debit right away. right? Also, the idea is to like keep these videos really short so that people are engaged and interacted in these videos. Do not want these videos to be too long and bore the hell out of people. So if you think I'm talking too much and the videos can be shortened, just let me know. Anyway, $1,039. Where did that come from? So you're paying 1039, which is $10.39 for one contract, which controls 100 shares. So you just multiply this number by 100. That's the max loss. So even though you are trading only one contract, you're controlling 100 shares of SPY. When you confirm a send, you'll see everything here. This is the ticket. And we can discuss this. There is a 65-cent charge to trade each leg of the option. There's no charge for equity trading, but there is a charge for this. Let's go on to the call side quick. Exactly the opposite. So the underlying has to move down, and then if I open this up, you see the put option is trading cheaper. But again, like this is usually you see put skew in the SPY and the main indices, but right now the markets are closed, so the put is showing to be trading is slightly cheaper. So this is how the put option looks. Again, it has to make money first, $5.99, in order for you to break even, and then move in. Now let me show you the sell side of it. So these are the buys, right? So change the buy to a sell. Now also look at these Greeks. Buying a put is basically negative deltas, negative theta, and positive vega. You're buying volatility here. On the sell side, it's the exact opposite. So you're long deltas now. So when you take a long position, you are selling a put option. That's long deltas. Now you're short vega, short gamma. With short options, you always have short gamma. And then you always are long theta, meaning you collect money on the decay of the option. The call side is the exact opposite. This is the short side of it, so you collect short deltas. The long call is long deltas, short call is short deltas. So this was the bid and ask difference. So if I was trying to buy the option, it was costing me $10.39. Now if I have to sell it back to the market right away, they'll take it from me at $10.35, and this is your bid ask spread, 4 cents here, which is very tight. I think the market opens is even tighter. It's 1 to 2 cents. This is what the market making firms profit is. So this is the basic options setup here. Let's move on to the next topic.